Inflation. It's the word that has everyone talking. Yes, that's right, prices are rising and they aren't showing any sign of slowing. Over the last 3 decades, we've enjoyed a fairly consistent period of low inflation rates. But things are changing. By the end of 2021, inflation in the US spiked to 6.2%, hitting a 30-year high and sending a shiver down the spine of global markets. And we don't need to look far to feel the heat. Food, commodities, houses and stocks are soaring. Wages, on the other hand, are not keeping up. And our cash in the bank is basically moving backwards. Some analysts think this current situation could spell disaster for the US and therefore the global economy. In this video, I'm going to look at what has some policymakers so worried about inflation, what the worst case scenario might look like, and why the US is in the firing line. As economies grow and develop, inflation is expected to rise. It's the job of central banks to maintain an average inflation of around 2 to 3% per annum for developed economies like the US, the UK and Australia. So with the US hedging at around 6% while the UK is up around 5% by late 2021, things haven't looked this dicey since the GFC. Only this time, there's a lot more moving pieces. And because wage growth isn't rising to match, things like petrol, meat, and household appliances are starting to get really expensive. To fix this under normal circumstances, central banks typically raise interest rates. This makes the costs of borrowing money more expensive, businesses start to slow, and price growth slows with it. The property market is the most obvious example of this. When you lift interest rates, it makes it more expensive to get a mortgage. People stop buying properties and property prices fall, and the same thing happens right across the market for all sorts of goods. And when the Federal Reserve raises rates, it also makes the USD stronger against other currencies. Since the US imports more than it exports, that should bring down the prices of everyday items. So with prices jumping to record highs in 2021, you might be wondering why the Federal Reserve didn't just raise the cash rate. Here's the problem. These aren't normal circumstances. In fact, we're navigating through very uncharted waters. Central banks have been reluctant to raise interest rates because global economies are still recovering from the COVID-19 pandemic. And the pandemic is actually part of the reason prices are staying artificially high. The lockdowns and other factors surrounding the pandemic have created supply chain bottlenecks. This has meant there's a shortage of goods the world over. Since the US relies more heavily on imports over exports, prices there are increasing more than in a lot of other places. And these supply disruptions are happening at every level, including oil, gas, and coal supply, which has in turn resulted in soaring energy prices. And when energy is expensive, everything else gets more expensive too. And it's not clear when these bottlenecks will return to normal, and here's why. First, businesses are operating under stimulus conditions. That means they're getting special tax benefits and other payments from the government, meaning in some circumstances it might actually benefit them to reduce supply of their products. Plus, record numbers of people are quitting their jobs. In the US, 4.3 million people resigned from their work in August 2021 alone. And many of these are from lower wage or difficult jobs, such as truck drivers and warehouse staff, which are needed to keep supply chains running smoothly. Also, energy prices can be unpredictable at the best of times, thanks to environmental factors and supply decisions from major oil producers like Saudi Arabia and Russia. Plus, the US and many other global economies like Japan are massively in debt. Public debt in the US sits at around $29 trillion, quadruple what it was 20 years ago. As Kylie Evans from CNBC pointed out in a recent article, the Federal Reserve is actually a big borrower from US companies, thanks to its quantitative easing measures, to the tune of around $6 trillion, or around 25% of GDP. In other words, if rates go up, the Fed itself will be one of the worst hit. So while some central banks around the world, such as in New Zealand and Norway, have already lifted rates to combat inflation, the question is whether the US can actually afford to do it themselves. If the Fed doesn't raise the official cash rate to cool inflation, the extreme scenario is runaway inflation or even hyperinflation, which is what we saw happen to Germany after World War I. The government needed money to pay for war reparations, so it just printed more money. As prices started to rise, workers started protesting their low wages, and more money was printed to pay them. At the height of the disaster, workers were getting paid twice daily because their prices were rising so quickly their salary was actually worthless by the end of the shift. A loaf of bread that was worth 250 marks at the start of the year in 1923 was worth 200 million by November that year. The life savings of entire families were essentially worth nothing in a matter of months. And similar inflation events have happened in more recent times in Zimbabwe, Yugoslavia, and Hungary. While catastrophic for economies, it's pretty rare. But some believe that's exactly where the US is headed. This idea blew up after Twitter's co-founder Jack Dorsey issued a dire warning over his platform that hyperinflation is going to change everything. It's happening. The argument is that the Fed is printing too much money. Too much money getting printed with little or no economic growth are the two main ingredients for hyperinflation. But hyperinflation by definition is pretty extreme. Inflation rates would need to hit at least 50% per month to meet criteria. While most analysts don't believe this will actually play out, many are predicting a period of extended inflation through 2022 or even a few years beyond, and the Fed itself has admitted as much. Perhaps more likely than hyperinflation is something called stagflation, which is where you get rising prices and weak economic growth or a recession. We've seen this happen before in the United States and other developed economies, including Australia in the 1970s. And it's actually a growing concern for a lot of people. Google searches for stagflation in 2021 hit their highest level since 2008, while Goldman Sachs noted the term is now the most common word in client conversations. And there's an argument we're actually in a stagflationary environment already. To help cool inflation, the Fed will ease its quantitative easing measures, which are propping up the economy. But if it does this too quickly, Nouriel Roubini, the professor of economics at Stern School of Business, argues it could crash credit markets and result in a recession. Even before COVID, the Fed had been using QE and cash rate reductions to prop up the economy during the US-China trade war. The Fed, Roubini argues, is in a trap, where any move it makes will have a negative economic impact either way. He predicts the US will face a medium-term stagflationary period worse than what we saw in the 1970s, when debt levels were much lower than they are today. The reason stagflation is so devastating is that an economic slowdown typically leads to rising unemployment. That's made even worse because money starts to lose value as prices continue to soar. I followed up this point with AMP's chief economist Shane Oliver, who also believes it's a risk.
Of course, that's the worst possible combination because it means weak profits, high and rising interest rates, and declining standard of living. I don't think we're going back to that extreme. I think central banks are still very mindful of the need to keep inflation down, but it's a risk. The complication at present, and this is why it's a bit unclear as to whether central banks should suddenly jump in and jam the brakes on. The complication is that we went through a pandemic.
During the pandemic, the US delivered stimulus measures that were even greater than during the GFC, totaling around $6 trillion. These monetary policies have helped to keep prices up, but with the additional supply chain blocks, prices have arguably gone too far. But analysts have been totally at odds over how extreme this inflation will be and how long it will last. Well, if you thought all of this talk about inflation and hyperinflation was confusing and a bit scary, there's yet another theory that's gaining traction, which is that we don't need to worry about inflation at all, but quite the opposite. Deflation. This is where prices fall, and this is generally bad news too. Cathie Wood of ARK Invest is someone that believes deflation is the real story in 2022. And she's been pretty vocal about it against Dorsey and Elon Musk on social media. In her view, technology innovation will continue to keep prices down. In a tweet, she said she predicts that this outcome will keep 10-year bond yields below 3%, which will support the stock market. Well, that's good news for hedge fund managers like herself, and doubtless she'd like this to be the outcome. And AMP Shane Oliver also sees a case for deflation following the COVID lockdowns, which resulted in a global shopping spree.
And so suddenly you got this massive surge in goods demand globally. Obviously the US example is a good example of that, but also in Australia, at a time when production was weak. Initially, they were able to run down inventories, but you can only do so much of that. Then we got to a point where the inventories ran out and suddenly we're left with a shortage and prices shot up. When things reopen again, and you don't necessarily want to buy another new boat or another new car or another new lounge setting because you just spent that money. And so you could go to a situation where we end up with an oversupply of goods, say next year, and falling inflation.
When there's too much deflation, people and businesses stop purchasing goods, with the expectation prices will continue to drop in the future. Businesses slow production and start to lay off staff, or they drop wages, which in turn adds extra pressure to prices as those unemployed staffers stop buying things. In the worst case, we enter a recession and stock markets crash. Oliver thinks this is why central banks have been so reluctant to cut interest rates so far. So to wrap this up, the main reason we're seeing so many opposing views is that we're in totally uncharted waters, and there are a lot of moving pieces. Supply chain blockages and energy shortages pushing up prices, it's just one part of the story. And cryptocurrencies add another unknown element, since they're sometimes viewed as a hedge against inflation. If inflation does get out of control, we could see more funds pour into digital assets like Bitcoin, which could also have unknown consequences. And there's also stimulus measures happening all over the world that will be having unexpected outcomes on business. Most analysts agree with the Fed that we'll see higher than usual inflation until at least 2022 to 23, and it's unlikely we'll see hyperinflation or even deflation. And depending on how you view stagflation, well, we're already in it. And as for the inflation versus deflation debate, well, it won't be an easy path ahead either way, and it's possible that both camps could have their day eventually over the coming years. Regardless, what I do know for certain is that it's going to be a bumpy ride ahead. Thanks so much for joining me. If you like this video, hit the like and subscribe button to get more videos just like this. If you've got any suggestions on future videos, feel free to add them into the comments section. That's it from me. Thanks guys.